Welcome. In this episode, we will discuss recent developments in the U.S. stock market, focusing on Walmart's latest financial results, valuation, growth expectations, and how it compares to other major companies in its sector. The information presented here reflects analytical opinions based on publicly available data in financial reports. It is not investment advice. Every investor should conduct their own research and make decisions based on their individual financial situation, risk tolerance, and future expectations. Currently, the U.S. stock market is experiencing what is known as sector rotation. This happens when capital moves from one sector to another based on market sentiment and expectations. Recently, there has been increased fear and uncertainty in the technology sector, which has caused significant declines in several major technology companies, including Meta, Amazon, Microsoft, and software companies in general. Google also experienced some decline, though less severe. Concerns about artificial intelligence and its impact on future profitability have contributed to this uncertainty. As a result, capital has moved out of technology stocks and into defensive sectors, including consumer staples and retail. This shift has caused defensive companies to experience valuation expansion. For example, Costco currently has a price-to-earnings ratio of 53, which is extremely high. Walmart has a P/E ratio of 44. In comparison, Amazon has a P/E ratio of 28, Target has a P/E ratio of 13.9, and Kroger has a P/E ratio of 13. These numbers show a significant valuation gap between defensive retail companies and other companies in the same or related sectors. This valuation expansion is primarily driven by capital seeking stability rather than strong growth. Looking specifically at Walmart's latest financial results, revenue increased by 5.6%, which falls into the mid-single-digit growth category. Adjusted earnings per share increased by 12%, which is a strong increase relative to revenue growth. However, this suggests that cost reductions and operational efficiency improvements likely played a significant role in boosting earnings, since sales growth itself was not particularly strong. Sales increased by 4.6%, and on a year-over-year basis, overall growth remained relatively flat, indicating limited expansion in core operations. One of the strongest areas of growth for Walmart was global e-commerce, which increased by 24%. This reflects Walmart's continued focus on strengthening its online presence and competing more aggressively in the digital retail space. Global advertising revenue increased by 37%, which represents another strong growth area and demonstrates Walmart's ability to monetize its platform and customer base beyond traditional retail sales. International revenue increased by 11.5%, but it represents a relatively small portion of Walmart's overall business. International operations generated $35 billion, while total company revenue in the fourth quarter reached $190 billion. This means international operations represent approximately 15% of total revenue, which limits their overall impact on the company's performance. The main concern comes from Walmart's forward guidance. The company expects total growth for 2026 to be between 3.5% and 4.5%, which falls into the low single-digit growth category. This is significantly below analyst expectations of 5.9%, which falls into the mid-single-digit range. This conservative outlook suggests slower growth ahead. Earnings guidance is also weaker than expected. Walmart forecasts earnings per share between $2.75 and $2.85, compared to analyst expectations of $2.97. Additionally, first quarter 2026 earnings per share are expected to be $0.63, while analysts were expecting $0.68. This indicates near-term earnings pressure and slower momentum. Despite these slower growth expectations, Walmart continues to return capital to shareholders through share buybacks and dividend payments, which provide stability and income for investors. However, valuation remains a key concern. With a P/E ratio of 44 and expected growth in the low single digits, Walmart appears expensive relative to its growth rate. High valuations are typically justified by strong growth, but in this case, growth expectations are relatively weak. The current elevated valuation is largely driven by defensive positioning and sector rotation rather than strong fundamental growth. When market sentiment shifts and capital returns to technology stocks, defensive stocks may experience slower performance or valuation compression. Based on these financial results, growth forecasts, and valuation metrics, Walmart currently appears to have limited growth potential relative to its valuation level. While the company remains fundamentally strong, stable, and profitable, the combination of low expected growth and high valuation suggests limited upside compared to other opportunities in the market. The stock has declined slightly, but technically it remains in an uptrend. Future performance will depend on earnings growth, sector rotation, and overall market conditions. If you found this analysis useful and want to stay updated with the latest developments in the U.S. stock market, make sure to subscribe to the channel so you don't miss future updates and in-depth market insights.